Perfect. Recording in progress. Okay, great. So that was Ro, guys. So Ro said hi to everyone. So basically today what I want to do is take you through the financial planning basics. So how do we even start thinking about money, how we should manage it? And then I'll take you into an introduction of investing. So what does it mean to invest? What investments are available in the market? What are the risks and characteristics of each of these investments? And then what tools are available for you to actually start getting invested? And then lastly, how do we choose the right investment for what your financial goals are? So feel free again just to jump in as and when, but I will get started. So the reason everyone has this misconception when it comes to saving that actually if we save, it's enough. But that's not actually the truth. So let's take it back to basics. And we know that if you were to save your money in a bank account, you would earn 3% in interest. But the average inflation rate in Kenya is 5%. So what is inflation? Inflation usually means that, let's say, for example, you had 1,000 bob today. That 1,000 bob will allow you to buy 5 bananas, but in 2 to 3 years' time, that same 1,000 bob will only allow you to buy 3 bananas. So inflation, and I'm sure some of you know what it is, but means that the value of your money is decreasing because of other factors in the economy. And so saving is not enough, because if inflation is at 5% and you're only earning 3% in your bank account, that 1,000 bob today you have in your bank account will be worth 995 bob in next year. So next year. So this is why saving is not enough. And there's this misconception that that's the way to get rich. It's not. We have to think about your savings portfolio, and then how do we invest it to make sure your money works for you and not the other way around, where we're always working for money. So this is a pie chart which gives you a bit of a rule of thumb. So all of us earn an income. Every month we get paid an income, and from that income, this is roughly how you should be spending your money. And I think a really important step when it comes to saving is, for example, taking your monthly expenses over a 3-month period and actually going through them to understand where is most of your money going. And one key thing that we find is that when you do this exercise, so for example, if you pay by M-Pesa, you can download your transactions or your bank account, download them and put them into buckets of rent, utilities, transport, food, others, and savings, to just give you a better understanding of how much am I saving today and where can I save money. So on a high level rule of thumb, on average, it would be amazing if you're already saving 30% of your income. And the best practice to do that is when your money comes into your bank account, automatically you transfer 30% into a savings account to begin with. And then really see, okay, how much is my rent costing? Is it 20% of what I'm earning? Am I spending more than 25% on food? If so, that's maybe an area that you can reduce your expenses. And this is sort of a high level, and I'll share this with you after the call, but this is a high level allocation of what you should be spending your savings on. No, usually a 30% is quite high. So if somebody can save 25%, that's also a great way to get started. And one thing I'd just like to highlight here, when you're doing the exercise of going through your monthly expenses, look at the things that feel like small amounts. And an example could be, us gentlemen on the phone might enjoy sports gambling, and every 2 days we're betting 200 shillings on a sporting event, and only once in a month you make a bit of money, like 1,000 bob. But that sort of behavior of thinking that it's only 200 bob is actually quite expensive, because if you were to allocate it, accumulate it over a daily period, that really adds up. So it's really looking at what your small expenses are. Can we reduce those? So if that's whether going and buying a coffee every day, do you really need to buy a coffee? It's only 200 bob, but can we save 200 bob? So it's fine coming through the exercise to actually look at where can I save more money, because every little shilling helps. So now that we've sort of understood how we should be looking at our financial portfolio, high level, what we should be spending on each of those buckets that I mentioned, the real knowledge comes in understanding what you should be doing with your savings portfolio. So I mentioned 30% is great if you're saving that, but most of us probably are saving 25% of our income. And then when you look at that 25% of your income, that portfolio should be divided across 3 key buckets. The first one is an emergency fund, second one's opportunistic fund, and then long-term portfolio. So an emergency fund is basically 5% of your overall savings that you keep in a very liquid, easy accessible account. And this is essentially for if you lose your job, you should be able to cover 3 months worth of expenses so that you're not in trouble. Now, of course, when you lose your job, you would not spend frivolously on going out for dinner, etc. So your expenses come down. So usually you don't need to look at your full monthly expense. You can bring it down and save 80% for the next, and have 80% of that spending in your account for 3 months. And usually this type of money is held in your bank account, a money market fund, something that's easily accessible, because the idea is you can quickly rely on it should something happen. So if someone falls sick, you have some emergency repairs in your house and the likes. The second opportunity or segment of your savings portfolio should really be opportunistic. And this is essentially 20% allocation that basically, what we found actually when we're speaking to a lot of our customers is they have too much money in really high risky investments. So let's take crypto, for example. When you speak to Kenyans today, they'll say, yeah, I have all my savings in crypto. Crypto is a very interesting asset class. We all have different views on it, but I don't think anyone can say they really understand how crypto is going to do. And so having all your savings in this really risky asset class is a bad way to do it. If you would like to invest in crypto, you should look at only having around 20% of your full savings in that type of portfolio. Another example is your friend wants to start a business and they've asked you to borrow some money. You don't want to give them all your savings. You'll say, okay, from my portfolio, I'm willing to take a little bit of risk, which is opportunistic portfolio, and I'm willing to give you some of my 20%, because starting a business can be quite risky and you don't know when you're going to get the money back. And this goes for any type of investment that you think could be a good idea, but don't know much about and don't fully understand. And that's essentially known as your high risk portfolio. And I'm going to give you another example. So if you look at shares, so that would be like Safaricom shares, Apple shares, Tesla shares. When you're holding an individual company, that would also fall into your opportunistic bucket. And the key thing that we're going to focus on today is the long-term portfolio. So the long-term portfolio is a portfolio that helps you build wealth responsibly over time. And the idea is that majority of your savings should sit in this bucket. It's not a get-rich-quick scheme. Those things don't work. The idea is really to build towards your savings and investment portfolio by investing in low, medium, high risk instruments, which I'll talk about shortly. Instruments means investments. And the idea is to hold it over term and build over the long term and build it over time. And again, when it comes to savings, I think there's a few misconceptions that people have that firstly, in order to invest, I need large amounts of money. That's not true. You can get started with as little as 1,000 bob a month if that's what you can do. And secondly, the important thing is for you to actually think about financial goals and how we come about to that. And I will talk about that slightly towards the end. But these are your 3 buckets that you should think about. Again, these are like high level allocations, of course, depending on the type of person you are. If you're comfortable taking more risk, you can up your opportunistic bucket and vice versa. So what's investing? So investing is a way to potentially increase the amount of money you have today so that you can achieve financial freedom. Investing seems to be very complicated. We'll talk through how you can look at the key characteristics of investment. But before we do that, I want to take you through 4 asset classes. So that would be real estate, land, because that sort of falls hand in hand. In Kenya, people love to invest in land, bonds, unit trusts and mutual funds and ETFs. They're all interchangeable. They're just funds. And then lastly, stocks, shares, and equity, which again mean the same thing. And I'll take you through the characteristics of that. So firstly, looking at real estate. Now, real estate more generally is a very easy to understand investment opportunity. Our parents have been doing it for years. And it's basically a physical asset that one can feel and touch. It's known as a safe investment because that physical asset isn't going anywhere. It's always going to be there regardless of changes in things in the economy. However, if there was a hurricane and it got caught in, then it would be damaged, but it's still a safe investment because the likelihood of that happening in Kenya is very low. And typically, the real estate asset class, which is basically buying a house, an apartment, a building that is paying rent, is known as income generating. So what I mean by that is, let's take an apartment for an example. You invested 3 million shillings in an apartment. Your apartment, you found someone to rent it. Every month it pays you an income. So it's a really good asset because if you have assets that pay you an income, it means that you are always always have money to help with your day-to-day or monthly expenses because you have additional money coming through. The only downside about a real estate investment is that it's illiquid. And the reason being is that, if you emergency needed your $3 million back from that apartment, you could be selling it at a time where the property market is not doing too well. And so you'd sell it at a discount, at a lower price than you bought it at. But also it takes very long time to find a buyer. So real estate is a really good investment to hold, but it makes part of your allocation and not all of your savings portfolio. So I wouldn't recommend putting all your money into just real estate. And this is why, and one thing I would like to clarify, because we have learned loads about the Kenyan culture, and we all tend to go in farmer saving groups and go and buy land. Now, land is a very poor investment decision if you're buying it in an area where the city. So when you buy land, you usually buy in rural areas where you think that the urbanization will take over and there will be development and people will come and move into that area. But typically what happens is that we're not very good at judging where that's going to happen. So we buy parcels of land where we can't farm on, we are unlikely to build on. And then when our children are going to university, we need that money, but the land, we're finding it difficult to sell the land because it's illiquid. And over the time that you are holding it, it doesn't even give you any income. So that's why it's not a very good investment. However, if you do buy it in an area like Westlands, etc., and then you're able to sell it to somebody or a developer, that's a great investment. So I would say land is bad, but typically people are so comfortable buying land, thinking it's real estate. I just wanted to differentiate the two, and I hope that's clear. So the next asset class is bonds. In simple terms, a bond is an IOU. And what happens is the person who is issuing the bond, so let's take the Kenyan government as an example, tells you that they owe you some money. If you lend them some money today, they will pay it back to you over a period of time. And they will also give you an interest rate, a monthly regular payment based on an interest rate amount. And typically bonds are seen to be very risky. They're known to be guaranteed simply due to the nature of the actual instrument. And so an example of a really good opportunity that we have at the moment is the Kenyan government infrastructure bond. The government is asking the general public to lend them some money, and they want the money to be lent over a 21-year period. The bond issuer in this situation, who's the government of Kenya, is a good sovereign, and they're unlikely to default. And they have said that they will be giving you 12.5% in interest every single year for you lending them the money. And then every year they'll pay this income twice a year. And the beauty about this government bond is that it's tax-free. So other government bonds, such as corporate bonds offered by companies, so this is where a company goes and asks you to borrow money, and then they pay you the money with plus interest over time. Those types of instruments are taxed. Whereas this particular infrastructure government bond is a tax-free bond. The beauty of bonds as well is that they're liquid. So typically you can sell, so say for example, on this infrastructure bond, it's being offered for 21 years. You don't have to hold it for 21 years. You can sell it through the Nairobi Stock Exchange to another party in 5 years, 2 years, 1 year, 10 years, whatever you feel. And typically bonds are a very low risk asset because we know that you're very likely to get the money back. The only risk with a bond is making sure that the company you're lending to, giving your money to, is a secure entity and that they will be around in 21 years to pay you back your money. Also, feel free to put any questions in the chat. And if something doesn't make sense, please unmute your mic. So in terms of funds, there are lots of different names for funds. Essentially, a fund is a collection of assets. So if we look at this basket here, if we look at an equity fund, it is a collection of equities in one basket. So that would be the simplest way I would explain what a fund is. Funds are interchangeable. So you're probably all familiar with unit trusts. So these are offered by companies like ICA Lion, Britam, Sanlam, and the likes. Exchange traded funds, also known as ETFs, are just another fund, but offered by global companies, and they have simply a whole bunch of equities or bonds in a basket. And typically these unit trusts are funds that are managed by professionals. So in this example, if we took a money market fund that is being offered by Apollo Asset Management is the professional that says to you, please give us your money for investment and we will invest your money and pay you a return at the end of the year, but we will charge you a fee for it. And the reason why managed funds or funds are a very good way to invest your money is because you don't have to do the heavy lifting. You don't have to think about when to buy your investment, when to sell it. We're also not equipped as a day-to-day individual or Kenyan to understand how markets move. So it is worth paying a professional to manage your money. Now, when it comes to funds, there's different types of funds. So they fall across different regions. So you can have Kenyan funds, global funds, UK funds, Asia funds. They also fall across different asset classes. So you can have a cash fund, a bond fund, an equity fund, a real estate fund. And they also are in different currencies. So like a local money market fund would be in Kenya shillings. If you were to buy an ETF in that holds the S&P 500, so a basket of the best companies in the States, that's in USD. And some funds are income generating. So they'll say, okay, going back to the real estate, if you have a rental income, that's known as income, it gets paid monthly. Some funds can also offer income. And the beauty about investing in funds is that, say today you're holding a money market fund locally and you needed to get your money out immediately. It's not like real estate where you need to wait, find a buyer, do the paperwork, and it could take up to 6 months. This you can sell out and withdraw your money immediately in 3 days. And the beauty about, or the idea about a fund, it's that it's transparent. So every day, if you were to look at your account, you'll know whether the fund has gone up in value or down in value. And the idea is that because it's managed by professionals, over the long term, you should see your money grow slowly over time. The benefits of the differences between mutual funds and ETFs is just, ETFs is like a version 2.0 of a mutual fund. It's more transparent, it's liquid, it's cheaper to invest in, and it has better tax benefits. Whereas mutual funds is like your first Apple iPhone that is now still around and still works, but now it has different versions that are much better. So like I mentioned, you also have the opportunity of holding individual stocks, shares of companies. So let's take an example. We all have heard Tesla, the world is looking to go green. Electric cars are likely to be the new thing. In about 20 years, I think we'll all be driving electric cars. And so if you saw that there's value in holding just Tesla, that's essentially a stock. So Tesla is listed on a stock exchange. They say to the public, if you invest or buy a stock or a share, our company is likely to be around in 10 years, and we will give you a higher price because we're looking to grow over time, and we have a strategy in place that will increase the value of our company, which means because you're holding a piece of our company, your investment also goes up. Now, the difference between holding a fund and a stock is that the fund is managed by a professional, so they take into account what's happening in the markets, what's happening to inflation, what's happening to the GDP per capita, and they will buy and sell stocks on your behalf. But when you're holding a stock, it is solely down to you to manage how that's going to do. So if you are holding Tesla, for example, you would have to really on a day-to-day basis consume enough information to make sure that Tesla is a company that's going to be around for the next year, 2 years, 5 years, 10 years. And in order to also be able to manage these stocks, you have to have a bit more financial deep understanding of what are the key factors that drive the value of a company. And so even though, and this is what makes it risky, is because we as everyday Kenyans don't have the knowledge, the skill set, the resources to really spend our time thinking about each individual stock. And so, yes, it's a good investment to have, but I think you need a bit more professionalism and understanding of the markets to make sure you don't lose money. Typically, there is a stat published by all most of these asset managers out there that 67% of retail investors, so those are people like you and I, would lose money when you hold stocks because we simply don't know when to buy and sell, and we don't have the expertise. So this is why they're seen as high risk. Stocks are also income generating. So sometimes, let's say Safaricom has had a very good quarter and a year, they then give you a dividend and you earn an income. And of course, stocks are super liquid because like Safcom, you can just buy and sell as and when you please through an exchange. And so like Safaricom is listed on the Nairobi Stock Exchange, Tesla, Apple, and the likes will be listed on the New York Stock Exchange. And you can simply sell in and out of these funds very easily. So that was like a quick run through like different types of investments, the characteristics and what you need to know about these investments to make a decision. But when it comes to investing, it's not timing the market that works, it's the time you spend in the market. And so this is because of a simple concept known as the compounding effect. And simply what that means is that the money that you invest today, so the 1,000 bob, will earn an interest and it will become 1,100 bob next year. That 1,100 bob then earns an interest year over year over year. So you're actually benefiting from compounding of the actual investment asset. So let's take an example of retirement. All of us don't want to work for the rest of our lives. We love working, but there is a time where we want to retire. So let's assume we needed 10 million shillings at the age of 65 to retire. Now, if you started investing at the age of 25, you would only need to save 400 bob every single day to get to 10 million shillings at the age of 65. That's because you have invested your money, it's earning return, it's earning a compound interest, and you can easily get to 10 million shillings by only saving 400 bob. But let's say you're 35 and you haven't started thinking about your retirement, but now you're saying, okay, at this age, you would need 12,000 bob every single month in order to get to that 10 million mark. And again, you're still in a good position because the market is earning a return. Your money that's making money is making more money, and vice versa. So if we were to jump across, say you started at the age of 55 and you said, oh gosh, I'm going to retire in 10 years. I think I need to start saving for my retirement. You would actually need 130,000 shillings to get to 10 million shillings by the time you retire. So the idea and the key point I want you to take away from here, whether it's 400 bob, 2,000 bob, 10,000 shillings, if you start early enough, that money continues to earn money. So your money sitting, it's called passive income. The money sitting in your investments continues to grow slowly over time, and you're able to have a lot more money in the future. And that's really how people get rich. It's not by working really hard jobs and hours. It's actually making sure the money that they have saved, how do they put it to work so they can earn more money? So how do you choose the right investment? Now, when it comes to deciding what to invest in, I think there's a couple of things that you need to look at to make sure that you're running the right amount of risk in your portfolio, you're generating the right amount of return you need to achieve your financial goals. So the first step really is to define and prioritize what are your financial goals. So these are things like saving for your children's education, saving for that dream house that you wanted to build over time, maybe buying a car, going on holiday, and then retirement. Now, of course, all our financial goals are unlikely to be achieved. I wish we were all Bill Gates and we had a whole lot of money, but we have to prioritize our goals. And what I would recommend is making a list of your financial goals, prioritizing them, pick 3, and then working backwards. So I'll take you through an example. So you have a child that they're at the age of 3. In 15 years' time, they're going to graduate from high school and they will want to go to university. We, of course, want to send our children to the best education institution there is out there, and hopefully they're smart enough as well. But we know that when they turn 18, the average term fees for university, and I'm just going to make numbers up here, is $10,000 a year, and they're going to be at university for 3 years. And then there's accommodation, spending money, etc. So let's add another 10 grand to that. So we know in 15 years' time, we will need around $40,000 to be able to pay for our child's education. So then you would work backwards and say, okay, if we have 15 years, and by the way, our solution does this for you, so you don't have to sit there and do it yourself, but how much do I need to save today? And really break it down on a month-by-month basis so it feels achievable for you to actually start saving towards your goal. And I think the big daunting thing is that we don't like to think about the big numbers, because 40,000 shillings is a lot of money, but you don't need it today, you need it in 15 years' time. If you go through the solution, we actually show you how easy it is to get there, but you just have to start today so you can get there. And so you would do the same thing about your retirement. So for example, you'd say, okay, I'm going to retire at the age of 65 and I'm probably going to live for another 30 years. What do I think my expenses are going to be on a monthly basis? Add that up and then say, okay, if I started saving today and I'm 36, for example, how much money do I need to save? But our solution does that for you. So it's just getting you to think about your financial goals. The next thing is, and I touched upon this, is how long can you invest for, right? So if we take the children's education, you've got 15 years. So if you're investing for 15 years, it means you can take more risk in your portfolio because you're not impacted by the short-term changes in the market. So if the value of your investment goes up or down, you're not impacted because what you're really investing for is over the long term. And if you look at historically at stock markets, if you look at a graph, it goes like this, because in the world, everyone is becoming more richer, they're consuming more. So these companies that are providing products and services will continue to do well. And if you look over the long term, passive investing, which is investing through funds, has outperformed stock picking. And the idea really is to invest for the long term. And so when you have the inside, like you hear Safaricom shares are down, oh no, but you're not saving for today or tomorrow, you're not trying to make a quick buck, you're saving for the long term. Safcom is going to be around for a really long time. The value of the company will go up in the long term. And then what is your risk appetite? So actually, this is really understanding, like, are you a low risk individual, a medium risk, or aggressive individual? But what happens is normally we have misconceptions to think, oh, okay, I think I'm an aggressive investor. But on a solution, what we do is we ask you a series of questions that are got to do with your lifestyle, how much you're earning, how much you're saving, do you have an emergency fund? And then our algorithms actually take that information and based on years of experience will tell you you are a balanced investor, and that means, or a conservative investor, and that your investing style should be like Warren Buffett, for example, to really give you an understanding based on not feelings, but actual data to say what type of risk you should be running. The next thing to consider is really liquidity. So when do you need this money? I always say when you're outlining your financial goals, you should just always have a nothing fund, just in case, like should you have to rely on that money because of unexpected unexpected events, it's something that you can pull on easily, and you don't have to break from your financial goals. But let's say, for example, if you did save for your child's education and they turn 18 and they're like, you know what, mom, dad, I'm just really good at singing and I want to be a rapper, all that money that you saved doesn't need to go to them, and that's good for you. You guys can use it for something else. And then lastly, it's about diversification. Diversification simply means not having all your eggs in one basket. So going back to the example that I mentioned earlier, some of our customers that we've spoken to had all their money in crypto, which is very dangerous. It's about holding different types of investments. So holding some cash, some equities, some funds, some bonds, and then eventually, as these instruments go up in value, you can buy more real estate, and really holding a variety of investments rather than one type of investment. So really what Ndovu does is we help you invest for your future, your family, and your retirement life. I gave you an introduction as to why we put this company together. What I realized when we moved back, well, when Ro and I started the company, was that people always in Kenya are investing not necessarily for the long term, but for short term, because they just don't know what the right investment options are. So we've really thought through the process of how do we help people understand what type of investment they should hold. And that was a series of questions I'll take you through just now, to really make you understand how to break down your financial goals. So this is a how does it work video. I'm just going to disconnect my headphones because it won't work otherwise. 1 second. Nelly, if we don't hear the sound, just let me know and I will repeat.
Is your money asleep? Your money is losing value every day. Are you working for money, or is it working for you? Hopefully both. Is it asleep in a savings account, an M-Pesa account, or under your mattress? You know you should be investing your money. Why aren't you? Because it's complicated, expensive, and time-consuming. Introducing Ndovu. Using state-of-the-art algorithms based on Nobel Prize-winning research, Ndovu automatically builds you a custom diversified portfolio at a fraction of the cost of traditional advisors. Simply answer a few questions so we can get to know you better, and we'll recommend a portfolio that fits your investing goals. Open your very own Ndovu account, and you can easily monitor and manage all your investments through the dashboard or leave it on cruise control. Ndovu is regulated by the Capital Markets Authority. Your money is held independently and securely in a top-tier custodian bank. Ndovu makes use of advanced encryption and blockchain, so your account stays safe at all times. Ndovu, rock your money.
I feel like the video probably did a better job of explaining. Let me put it on mute. Sorry, 1 second, it might replay again. Perfect. So this is our website. We have lots of information on there of how it works, but I wanted to skip ahead. I'm stuck. There we go. Perfect. So in terms of security, we're definitely regulated by Capital Markets Authority. But before I go into that detail, currently the partnership that we're running with organizations. So to date, we have over 35 companies that we work with. And the idea really is that we wanted to provide you with a opportunity to have a one-on-one free session. So normally we would charge for it, but because it's coming through Ndovu, we offer it. You have a one-on-one session with a financial advisor and you get a cheaper rate. We are the cheapest in the market today. We think because we have technology on our side, we are actually cheaper than regular financial advisors, asset managers who provide you advice. But in this time, I'd like you all to sign up, not sign up, but go onto our web. So I'm going to get Ephraim to share the link because I want you to have a play around with this solution. So I will share my screen as well while he sends that in the chat. So we're just waiting for it. Oh, there we go. So if you click onto the link here, portal.ndovu.co registration, it will take you through to the registration portal. So I wanted to take you through the solution. So I've signed up, but you can sign up here. I'll give everyone a couple of minutes just to sign up. Okay, so in terms of the solution, we have a dashboard here. And before, when you sign up, the part that I was mentioning about taking you through your questionnaire to really understand what type of investor you are. When you sign up, you should get this automatically, and you can just, it's quite intuitive, easy to follow. You basically select, answer the questions based, like what are you saving towards? So I'd say long-term investment growth. What is your monthly income? How much are you saving? And you get the gist, like how much money would you, if you lost your job, how long could you survive? So I'm in 5 years. So essentially we take you through these questions to really understand what is your understanding of investments. So I'll click on everything because I'm familiar with that. I'm looking for more risk opportunity. So based on this, the way you answer, it'll tell you what type of investor you are. I'm an aggressive investor because, of course, I've had exposure to different types of investments in the past. I'm also relatively young, I'd like to say, and so I'm investing for the long term, so I'm able to take more risk. I'm currently able to save enough money, and so it's telling me I'm a bit more of an aggressive investor. So once you've done that questionnaire, you have 2 investment journeys. You can either save using goal-based. This basically means that you don't really want to pick your individual investments. You want us to do it for you. So we've spent years and a lot of time putting together a solution to pick the right types of funds for you. And you can simply create a goal. So you can just say car, and then it's just simple questions that ask you. And then at the end, I'm just going to see if I have a goal set up. No, I don't. Yeah, so if you go through this journey, and I can actually show you, so at the end of this goal, I was saying, like, say if I don't have a child, but if I had a child and they were going to university, I'd probably need $40,000 to save that. I would put that in here, and at the end we tell you how we would save to get to that. Alternatively, you can say, look, I don't need any of your help. I know I would like to be in a bit more control. So I'd like to choose a general investing option. So I'd click select, and then under here we have recommended funds and also all, but I will go to all for now. And we have a money market fund here, several bond funds for you. And we also have a range of US funds. So if we just look at, apologies. So let's say, I think technology is going to be around for a long time. So we have a techie fund. We tell you what type of risk it is. It's medium risk. It's actually denominated in USD. It's based out of the States. We give you an example of what the tech fund does. So these are the companies that make internet tick, from routers to microchips to online platforms and devices you use to access it. These are brands that basically empower the whole technology in our future. These are the companies, some of the companies you'll be investing in. And this is how they've performed over a 1 year, 3 year, 5 year, and 10 year. Now, of course, historic performance, so past performance is not an indication of future performance, but on average, you'll see that this is a good fund to invest in. Last year was an anomaly because when the pandemic happened, we saw a lot of money move into the stock market. So sports was off. Yeah, people just had a bit more free time, and the pandemic also showed them that life can be unpredictable, and you need to definitely think about investing responsibly and really making sure that you have enough money for the future, because it's unpredictable. So we saw a lot of money come into the market, but on average for this type of fund, you'll see anywhere returns in the 20s most likely. And then we tell you, if you're more curious, like who is the fund manager, you can invest now, add it to your watch list, and then there's more documentation here to learn more about the fund. And so this is just one example, but we have a wide variety of funds that you can actually pick from, and you click on them and figure out. And once you've invested, the dashboard shows you how much you're holding. We also have an Ndovu Academy. So there's a really good blog on what a bond is. you can, of course, upgrade to premium. And then in your portfolio, it'll tell you the type of investments you're holding. So that was a quick whistle-stop tour of the solution. We now have about 10 minutes for question and answers. And I would open it up to the floor. I can see there's some questions in the chat.
A ton of the questions have been sorted already. I see Chris has asked a question around plans to add more funds, maybe other markets, FTSE. What I'll recommend here, Chris, is get onto the solution and actually see what we have. I think that might answer your question instead of just writing it down here. It's great if you see it for yourself. Sorry, back to you, Radhika.
Yeah, so we do definitely have a FTSE 100 fund on there. So if that's something that interests you, you can definitely invest in that. And the idea, guys, really about investing is starting small today and investing for the long term. So the way we've designed the solution today is not to have individual stocks today, because we wanted to encourage more regular saving behavior and investing responsibly, not taking a punt on thinking Apple's going to go up and then 3 days later I'm going to sell it. That's not really investing, that's gambling. So that's what we've done. But if somebody wants to set it up, we would, so people do ask us that they want fact like individual stocks. Eventually we have designed a solution to do it that way, but we've chosen to go through funds first. So there's a question from Nelly saying, why do I need to add my bank details when I register? So the bank details really is for us to complete your check and your identification and who you are. So Nelly's referring to this page. So I've completed mine. And basically you do have to, and ignore my bank account number, but we put it in here to make sure that when we do a check, it's in line with your identity. So you're not using a bank account from another individual that might be a high risk person. It's you who you say you are on the tin. Again, all this data is stored securely on our platform. No one else has access to it. It's all automated. Your KYC is done automatically. So the charges is a great question. So let me just move back to not the presentation. So here are the charges. So typically, let's say if you wanted to invest in this infrastructure bond, that's a great opportunity at the moment. So say you went to Standard Chartered or your bank. First of all, you would need a lot of minimum deposit, but for Ndovu, you can invest as little as 10,000 shillings to begin with. But then your equity bank or your Standard Chartered and the likes will charge you somewhere around 2% for that investment. But our maximum charge, is 0.95%, so just under 1%. We can do that because we're a digital platform. I also think the prices in Kenya are too expensive, coming from working at BlackRock and seeing what the fund manager prices are there versus here, it's too expensive. So we want to drive innovation into the market as well. And of course, if you sign up using this code, you fall into the premium bucket, and actually your fee comes down to 0.75%. I know it says here minimum 1,000, but that doesn't apply to you guys. That's just for other customers. But yeah, you actually fall under a lower tier of pricing. I hope that, Perez, I hope that answers your question. I'll pause there. Ro, anything you'd like to add? I hope I didn't make anything too complicated.
I think we, in addition to encouraging the listeners, guys from Fuzu, to actually check out the platform, I think we can also touch on the infra bond that's available right now.
Yeah, sure thing. I am seeing if I have the brochure available that we've been sending to everybody.
Okay.
1 second.
So as you're digging it up, let me just fill the space instead of the silence. So when you come onto the platform, what Ndovu actually does after profiling you is we give you a bespoke portfolio. That's a portfolio that matches your risk profile. And then we've set it up as the portfolio captures both local investments and international investments. This is the first time this sort of portfolio is actually being offered anywhere in East and Southern Africa. And one of the nice opportunities that is available is what Radhika has actually pulled up right now. This really is for those of you who are keen on deploying money into an investment, but you're very cautious around risk. So the government has issued this bond. It's currently on offer. The details are there. We can share this with yourselves post call as well. But note that the investment must be done by Friday, because there's a deadline issued by the Central Bank of Kenya. It's a very interesting bond. We think it give about 12.5% return. When you think about what you're getting, say in your savings account for the cash you've placed there, and the aspect of tax. So there's tax also on your savings. I think the government takes about 15% withholding tax on your savings. This is a very interesting offering. You get higher return, no tax on it. But what we also give you as Ndovu is, typically when you want to buy this sort of bonds, you have to go in at 100,000 shillings. You need to do tons of paperwork at CBK, which takes time. What we've done is digitize the entire process. You'll only get in for 10,000 shillings. Back to you, Radhika. I think there's a question there from Nelly. Absolutely, yes. So deactivating an account, this is guided by the Data Protection Act that was enacted in Kenya about 2 years ago. So all you do here is you request for account closure and data erasure, and we follow exactly what the Data Protection Act has laid out. Okay. Oops. Yeah, it does make sense, Nelly. I've reached the end of your question. I hope I have addressed it comprehensively. Back to you, Radhika.
Maybe, Ro, to add on to that, I think the question was mainly, so if I wanted to get back the investment that I've made.
Yes, it will go back to the channel you invested with. So say you'd come onto the platform, invested via M-Pesa, and you want to close out, like it's 100% withdrawal. The account side is closed, yes, and the money comes back the way you invested it. So M-Pesa comes back to M-Pesa wallet. If you did bank, it goes back to your bank. This is to comply with anti-money laundering regulations, both in Kenya and internationally.
Okay, perfect. Got it. I had another question on this. So I actually did sign up for this. So Tim, I would encourage you to do so. One of the things I noticed is if you top up, say 10,000, which is like the minimum that you can invest, it still does a deduction in terms of like the cost of using the platform. So does someone need to top up with the 0.95% in mind, or it's okay if you just do 10,000 as a start?
Fantastic question. I have to look at that. That's thanks for raising that. The system automatically should have indicated that it's the 10,000 plus the margin that is paid to Ndovu, the 0.95. I will look into this. Let me get back to you. If it actually deducted, that's something that should not be reflecting. I apologize for that, but I'll definitely get back to you on this personally.
Yeah, so Ro, I was just going to say, actually,
Yeah.
You're absolutely right, Nelly. When you go to invest, we actually show you a breakdown of if you're investing, because we want to be transparent in when we invest. That's the only cost you'll have. So we say if you're investing 10,000 shillings, we're deducting the 0.95. And so then you just, well, we would expect people to just intuitively add just a little, that 0.95 on, but if you haven't, it's not an issue. We'll still take your order as it is. But maybe that's some feedback for us to clarify internally.
Yeah, absolutely. If you've deployed, don't worry. As I've stated, I'll get back to you on this personally. So just know that 10K is actually going to be invested into the bond. Perez, your question regarding the bond. So you put in 10K now, government is going to pay you interest of 12.5. a year for the next 21 years. And that at the end, you're going to get back the original money that you actually invested. So your capital essentially is protected. Back to you, Rad.
Yeah, nothing further from my side. We can just, yeah, we're close to time. So we're 1 minute to time.
Okay, your network has
yeah,
flown away,
a
Radhika.
phone call was coming through. Yeah, so we'll set up we'll send the video as well, just so if you wanted to refer to it or share it internally. We'll also send the registration link and the discount code just for those who'd want to sign up. And of course, we're available to chat at any time. Even if you go onto the platform, we're trying to make sure our customer service is on point, because we know how important it is for you to get your questions answered. So feel free to drop us a note through the thing and we should get back to you within a couple of hours. Brilliant. So if we have no further questions, shall we bring the call to an end? Nelly, anything else? Any closing remarks?
No, I think definitely thank you very much for spending the time with us for the past 1 hour. I know most people are not able to make it, but if you can share the recording, that would be great. I'll definitely share it with them. Any links that you feel will be useful in addition to this recording will be great if you can share that with me. I know people will definitely have questions, so definitely encourage everyone to please reach out to the team. I may not be the expert in this, so please do not rely on me. So please reach out to the team to get as many answers as possible. It's a good way of you thinking about your future, or also COVID has taught us that we all need to have some fallback plan in case anything happens. So this is the opportunity to be able to think about that with people who are experts in that. So please reach out as much as possible. Would like to thank I think it was the max, we were 17 of us, so the 14 from our side who joined. Thank you very much, guys, for joining. I hope it's been very informative. Ask as many questions as you can, follow up as much as you can, and let's make smart investments. Yeah. And thank you very much, Radhika and team. I keep on butchering your name, so please excuse me. Please excuse me, but thank you very much for your time.
Thank you so much for your time. So I just see there's one more question from Perez. He's just saying, are the charges annual or one-off? So they're actually annual, and they're paid at the beginning, they're paid up front. So what we do is when you invest the money, we take it up front, then you don't have to pay any more charges thereafter. Yeah, so I hope that answers your question, Perez. Brilliant. Thank you, everyone. Bye-bye.